study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking.
All right. So it's time to get started. Time to work. All right. So you know, if you're watching this, I will be studying loud. So this is only for people who are studying for the CPA exam. So if you're looking for something for you to sit down and study yourself, that might not be the one for you. So this is a loud study session for people who are studying for the CPA exam. Okay, so let's go ahead and get started. All right, I think everything is in order. All right, so we are in FAR, and this is, most of these questions are EPS. Breako has 170,000 shares of common stock outstanding at January 1st, year 5. On May 1st, year 5, it issued 30,000 additional shares of common stock. Outstanding all year were 12,000 shares of convertible cumulative preferred stock. Each share of the convertible preferred stock, which was dilutive in year 5, is convertible into 1 share of BRICS common stock. What is the number of shares that BRICS should use to calculate year 5 diluted earnings per share? So what we are looking for right now is the denominator. So this is EPS. This is an EPS question, earnings per share. To calculate EPS or calculate earnings per share, the formula is net income minus preferred stock dividend, right? Net income minus preferred dividend divided by the number of shares or common shares outstanding. Weighted common shares outstanding. So what do we need? The question says, what is the number of shares that BRICS should use to calculate year 5 diluted earnings per share. So here we need the diluted earnings per share, not just basic earnings per share. All right, not basic EPS, but diluted EPS. So when we talk about diluted EPS, we are talking about all of the shares that could be diluted. They will all be included in the calculation. Okay, so knowing that, what do I do? Breakco has 170,000 shares. 170,000 shares of common stock outstanding at January 1st, year 5. Okay. On May 1st, year 5, it issued 30,000 additional shares of common stock. Okay. Outstanding all year were 12,000 shares of convertible cumulative preferred stock. 12,000 all year outstanding. Okay, each share of the convertible preferred stock, which was dilutive in year 5, is convertible into 1 share of BRICS common stock. Each share is convertible into 1 share, so it's 1 for 1. What is the number of shares that BRICS should use to calculate year 5 diluted earnings per share? We start with the 170,000. All right, we have 170,000. This is what we start with. January 1st. Now on May, there is another activity, another transaction on May 1st. May 1st, year 5. Issued 30,000 additional shares. So what do we do with these 30,000 shares? We will weigh these 30,000 shares based on how many months they were outstanding. So May 1st, May is the 5th month of the year. So it would be 9 more months. Let me see, May, June, July, May. Okay, it's May 1st. May 1st will also be counted. May will be counted too. Okay, because it's May 1st. If it was May 31st, we would not count, or May 30th or 31st, I don't remember. We would not count May. But now May, June, July, August, September, October, November, December. So 8 months. So these 30,000 shares were outstanding for 8 months. Let me check something here real quick. Okay. These 30,000 shares were outstanding for 8 months. So what we're going to do is calculate, it's 30,000 times 8 months outstanding divided by 12 months of the year. So it's 20,000 shares. Okay, when we weigh these 30,000 shares, they become 20,000. The other part of it says, so we add the 20,000 and 170,000, it becomes 190,000 shares now. So what else do we have? We have outstanding all year where 12,000 shares of convertible cumulative preferred stock. Why it's hard to say this word? Cumulative preferred stock. Each share of the, okay, so we have 12,000. They were outstanding the whole year. So that means we can just go ahead and add these 12,000 shares on the 190,000. So that would make it 102,000 shares. No, it would be 202. 202,000 shares. It would be 202. And let's see. Convertible cumulative. Okay. If it's cumulative. This sounds like there is something else that I need to calculate. I don't remember. But let me see something. See something here real quick. Okay, so step 1, calculate the weighted average common share. At January 1st, 170,000 common shares outstanding. On May 1st, issued 30,000 additional shares. Those 30,000 shares were outstanding for 8 months, May to December. Weighted average effect. It's 30,000 times 8 months outstanding divided by 12 months of the year. It makes it 20,000. So basic weighted as that 12,000 shares of convertible cumulative preferred stock. Each preferred share is convertible into one common share. The preferred stock is dilutive. Whenever convertible preferred stock is dilutive, use the if converted method. That means if converted, it would be converted. Okay, let me continue with that. The CPA exam assumes the conversion happened at the beginning of the year. That's right. Therefore, add 12,000 times 1 equals 12,000. Additional common shares are 12,000, so it's 202. That's exactly what it is. Okay, yeah, 202. We got it right. Wilkin Company is calculating earnings per share amounts for inclusion in Wilkin's annual report to shareholders. Wilkin has obtained the following information from the Controller's Office as well as shareholder services. Net income from January 1st to December 31st, $125,000. Number of outstanding common shares. January 1st to March 31st, 15,000. April 1st to May 31st, 12,500. June 1st to December 31st, 17,000. In addition, Wilkin has issued 10,000 incentive stock options with an exercise price of $30 to its employees and a year-end market price of $25 per share. What amount is Wilkin's diluted earnings per share for the year ended December 31st? Okay, this is also another diluted earnings per share, but this time we need to calculate the EPS itself. So to calculate EPS, you already know the formula. It is net income minus preferred stock dividend divided by what? Divided by weighted average of number of common stock. Weighted average of common stock. Yes. What we need to complete numerator is the dividend. Number of outstanding common shares. Okay, we have number of outstanding common shares. In addition, Wilkin has issued 10,000 incentive stock options with an exercise price of $30 to its employees and a year-end market price of $25 per share. Okay, so we don't have any dividend. We don't have dividend, but I need to know what to do with this incentive stock option. Incentive stock options. What do I do with that? So let's get an explanation of this. Okay. All right. This is a beautiful CPA. This is a beautiful CPA question because it tests two concepts at the same time. What are they? Weighted average shares outstanding, treasury stock method for stock options. Let's go phrase by phrase. Calculate basic weighted average shares. Okay. All right. So, weighted average shares outstanding. Second, treasury stock method for stock options. Let's go phrase by phrase. Step 1, calculate basic weighted average shares. January 1st to March 31st. 15,000 shares for 3 months. So 15,000 times 3 divided by 12, 3,750. April 1st to May 31st, 12,000 shares for 12 months. 12,000 times 2 divided by 12, 2,083. June 1st to December 31st, 17,000 shares for 7 months. So 17,000 times 7 divided by 12, that's 9,917. So total weighted average shares outstanding, it's 3,750 plus 2,083 plus 9,917. So that's 15,750 shares. So basic EPS denominator is 15,750 shares. Step 2, examine the options. The question says 10,000 incentive stock options. 10,000 incentive stock options. Exercise price is $30. Market price is $25. Immediately ask, are the options dilutive? For options to be dilutive, market price needs to be greater than exercise price. Remember that. For options to be dilutive, market price needs to be greater than exercise price. Think, why would employees exercise a $30 option when the stock only sells for $25? They would not. They would lose. $30 minus 25 is 5, right? $5 per share. These options are out of the money. Therefore, not dilutive. Treasury stock method not used. Add 0 shares. Step 3, diluted shares. Because the options are anti-dilutive, diluted shares equals 15,750. Step 4, calculate diluted EPS. Net income, 125,000 diluted shares. Net income, 125,000. That's what we said? Yes, net income is 125,000. Diluted shares, 15,750. So we do 125,000 divided by 15,750. So EPS is $7.94. $7.94. This is a little bit more complicated We will go back to it so we master it. CPA exam shortcut. For stock options, if market price, exercise price is greater than exercise price, use treasury stock method. Example, market equals $40, exercise equals $30, it's dilutive. If market price is less than exercise price, ignore the options. Example, market price is $25, exercise price is $30, anti-dilutive. Add 0 shares. Memory trick. Ask yourself, would I pay $30 to buy something worth only $25? If the answer is no, the options are worthless and have no effect on diluted EPS. It makes sense, but let's lock this in. So the question, the only variance here in the question is where they talked about the options. All right, so let's lock this in. This question is testing 2 concepts. The first concept is weighted average shares outstanding. And the second concept is treasury stock method for stock options. Okay. So what do we have? We have number of outstanding common shares. This is very important because it says that we have 15,000 shares outstanding from January 1st to March 31st. So this is 3 months. This 15,000 shares were outstanding only for 3 months. So what we're going to do is to do 15,000 times 3 months divided by 12 months of the year. And we keep that on the side. We have 12,500 shares from April 1st to May 31st. So we'll do the same thing. From April 1st to May 31st. So that's 2 months. What we're going to do is 12,500 times 2 divided by 12. And then we will put that on the side. It's 2,083. Then we have another transaction. The third one is from June 1st to December 31st. 17,000 shares. Again, this is going to be for 6 months. No, this is 7 months because we need to count June. June is part of it. June 1st. So 17,000 times 7 months outstanding divided by 12. Okay? So that's going to give us 9,917. So what do? We will go ahead and add them up. Okay? And the total is 15,750 shares. So basic EPS denominator, which is the denominator in the formula, is 15,750 shares. So now the options. This is what was a little complicated for me. Step 2, examine the options. The question says 10,000 incentive stock options. And listen to this. Exercise price is $30. Market price is $25. So you have the option to exercise it at $30 or to buy it at $30, but the market price is $25. Okay? Understand this part. So immediately ask, are the options dilutive? We need to know if they are dilutive. For options to be dilutive, market price, right? Market price here is $25, needs to be greater than exercise price. This is a little piece that we need to clip. For options to be dilutive, market price needs to be greater than exercise price. In this case, market price is less than exercise price. So think, why would employees exercise a $30 option when the stock only sells for $25? They would not. So they would lose $5 per share. These options are out of the money. Therefore, they are not dilutive. Treasury stock method not used. What we do is add 0 shares. We add 0 shares. So we don't even use these 10,000 shares because they are not dilutive. Okay? Why? Because market price is greater than because market price market price is what? Is $25. Exercise price is $30. So market price is less than exercise price. So for options to be dilutive, market price needs to be greater than exercise price. I need to remember that. Okay. So calculate dilutive EPS. To calculate dilutive EPS, we need net income. It's net income minus dividend. Here we didn't talk about dividend. There is no dividend. So net income is $125,000 divided by what? Divided by diluted shares. Diluted shares right now, the only shares that we have is the 15,750. So we divide 125,000 by 15,750. This is why we have 7.94. That makes sense? Okay. Be right back. I believe that makes sense. That makes sense so far. Okay. 792. $794. $794. Okay. If you didn't understand, please, all right. If you did not understand, please leave a comment. Let me know so we can come back and go over it again. Okay. All right, so we're gonna go to the next question in a minute. Get to the next question. All right. So next question. The per share amount must be reported. The per share amount must be reported on the face of a public company's income statement for which of the following items? per share amount must be reported on the face of a public company's income statement for which of the following items: income from continuing operations, preferred stock dividend, treasury stock, compensation effect of fair value on stock options. We need to understand the language. The per share amount must be reported on the face of a public company's income statement for which of the following items: per share amount, income from continuing operate, preferred stock dividend, per share amount. I would say preferred stock dividend. Compensation effect of fair. I would say preferred stock dividend. That what sounds like the answer for this question, but let me confirm. We need to confirm that. Per share amount, preferred stock dividend is the amount per share. Preferred stock dividend is the dividend that you get per share. Let me see. This is a pure EPS presentation question. The question asks which item must have a per share amount reported on the face of the income statement. The keywords are per share amount, face of the income statement. What must be reported? For a public company, GAAP requires EPS disclosures. For income from continuing operations, net income or loss, discontinued operations if applicable. The most tested answer is income from continuing operations. Why A is correct. EPS is meant to tell investors how much earnings did each common share generate. So companies must show income from continuing operations and net income, EPS, directly on the income statement. Why the others are wrong? B, preferred stock dividend. Preferred dividends are used in the EPS calculation. They are, yes. But preferred dividends themselves are not reported as a per share amount on the income statement. Okay. I think this is pure memorization. We need to answer a income from continuing operation. This is one of those FAR questions where knowing the reporting requirement is enough. You don't need to calculate anything. Income from continuing operations. Explain this question to me again, or the answer, to see how it makes sense, because the per share amount must be reported. The per share amount must be reported on the face of a public company's income statement. I need to understand that a little better. I was a little lost. Alright, what is used to calculate EPS? The question is not asking what is used to calculate EPS. The question is asking what must actually be displayed as a per share number on the income statement. Those are two very different things. Think of a real income statement. Imagine a public company earned net income equals $1 million, preferred dividends $100,000, common shares $100,000. Okay. At the bottom of the income statement, you might see income from continuing operations, EPS from continuing operations, net income, basic EPS. Notice what investors see. Income from continuing operations per share. They do not see preferred dividend per share. Okay, I see. So they don't see the calculation. They don't see that. Why not preferred dividend? Because preferred dividend is part of the formula, but you don't see it. It's not the calculation itself. All right, let me see. Why not preferred dividend? Preferred dividends are just an adjustment used inside the EPS formula. Think of them as an ingredient. Basic EPS is net income minus preferred dividends divided by weighted average common shares. Weighted average common shares. So the preferred dividend helps compute EPS, but investors are not interested in seeing preferred dividends per share. Okay. On the income statement, they want to know how much earnings belong to each common share. Okay. Suppose a restaurant sells a meal for $20. The menu shows meal price is $20. The menu does not show flour cost, salt cost, tomato cost. No. Those ingredients help create the price, but they are not what gets displayed. Similarly, preferred dividends is an ingredient. EPS, final product shown to investors. Why income from continuing operations? The CPA exam allows this. Investors want to know how profitable is the company's normal business, not one-time gains, unusual losses, discontinued operation. That's why GAAP specifically requires EPS for income from continuing operations. Net income, discontinued operation if applicable. The farm memory rule. When you see per share amount reported on the face of the income statement, immediately think earnings per share. You think EPS and ask EPS of what? Usually EPS of income from continuing operations, income from net income, usually net income, discontinued operation. Okay, never preferred dividends, never treasury stock, never stock option compensation expense. So I think we need to clip this. The trick in these questions is that preferred dividends feel related to EPS because they are inside the formula. But the question is asking what gets reported, not what gets used in the calculation. That's why income from continuing operations is the correct answer. My follow-up question is, what is the connection of income from continuing operations with EPS? Okay, this is exactly what this is the exact question you should be asking, because once you understand this, EPS becomes much easier. What is EPS trying to measure? EPS answers one question: how much profit belongs to each common share? Okay, think of a company as a pizza. Total profit, the whole pizza. Common shareholders, people sharing the pizza. EPS, how much pizza each share gets. All right, or each person. Why income from continuing operations? Because investors want to know how much money is the company's normal business making. Not a building they sold once, not a lawsuit settlement, a discontinued division. They want the profit from the business that is expected to continue. So GAAP requires EPS for income from continuing operation because that's the most useful measure of future earning power. Okay, so I think that's good enough. That's good enough. We can memorize this. If we don't understand the whole thing, we can memorize it. A company had 400,000 shares of common stock issued and outstanding on January 1st. How many stocks? 400,000 shares. Okay, year one. And had the following equity transactions for year one. And had the following equity transactions for year one. Transaction 1 issued 200,000 new shares for cash on April 1st. Okay, April 1st, 200,000 new shares for cash. Issued new shares as a result of a 3-for-1 stock split, July 1st. On July 1st, we have a split. Purchased 300,000 shares treasury stock for cash, October 1st. These, we have a few concepts to study here. What should the company use as the denominator for the calculation of basic earnings per share for the year ended December 31st, year one? This is not too bad. I think there are a few things that I need to consider. So we have 400,000 shares. This is what we start with. Outstanding the whole year, January 1st, from January 1st. Okay, so we start with 400,000. Then we have 200,000 new shares for cash, 200,000 new shares issued on April 1st. So April is the fourth month of the year, but since it is April 1st, these 200,000 shares will be outstanding for 9 months. So in our calculation, we will say 200,000 times 9 divided by 12. So that's 150,000 shares. So instead of 400,000, now we have 550,000. July, what did happen in July? Issued new shares as a result of a 3-for-1 stock split. Okay. But you're not telling me how many shares. I don't know how many shares these are. Issued new shares, but how many? Should new shares as a result of a 3-for-1 stock split. When you see a split, you will make as if they were outstanding the whole year. But here I have no number, I have nothing. So I think we need to calculate that somewhere. I'll come back to this. Purchased 300,000 shares treasury stock for cash. Now, when you purchase your own share, this is called treasury stock. And when you purchase your own share, your own stock, to calculate this, we need to calculate for how many months they were not outstanding. Right? When you issue shares, we calculate how many months they were outstanding. When you purchase your own shares, we calculate how many months they were not outstanding. So for the 300,000 shares treasury stock, October 1st. October 1st is 3 months. So they were not outstanding for 3 months. So we do 300,000 times 3 divided by 12. So 75,000 shares. 75,000. So we have 550,000 because we had 400,000 at first, And then 150, that's 550. 550,000 plus. No, purchase. When you purchase your own share, it's not going to be plus. It will be, you will need to subtract. So we will subtract 75,000 shares. So 475,000. But now there is a problem. The problem is the split. I don't know what to do with the split. So let me get some explanation. I know what to do with the split. What do I do with the split? Alright, so the question is testing one of the CPA exam's favorite traps. Stock splits are not weighted by time. I know they are not weighted by time. It is as if they have been outstanding the whole year. It is just like a stock dividend. Okay. Now, stock issuances and treasury stock transactions are weighted by time. Yes. Let's go step by step. Start with the original share. There's 400,000, yes. These were outstanding all year. I know. Step 2. Add the April 1st issuance. April 1st, 200,000 shares. And then when we weight that, it becomes 150,000, which is true. Okay, 150, so now we have 550,000. Step 3, handle the 3-for-1 stock split. This is what I did not understand. This is where most people get confused. It's my case. A 3-for-1 split means every one share becomes 3 shares. So are we talking about the 550,000 shares? So all shares before the split must be restated as if the split happened on January 1st. Okay, makes sense. I see. Okay. Think original 400,000 becomes 1,200,000 shares. April issuance 200,000 shares becomes 600,000. The split is treated retroactively for EPS. So before considering treasury stock, 400,000 plus 150,000 times 3. That's 1,650,000. Step 4, treasury stock purchase, October 1st. Purchase 300,000 shares. Treasury stock. These are removed from outstanding shares for 3 months. So 75,000, which we already knew. All right, so 75,000. So we have 1,650,000 minus 75,000. So that's 1,575,000. Okay, so that's what I didn't understand, the split. What do you do with the split? You will go back when you have the split, like you say, issued new shares as a result of a 3-for-1 stock split. So what are the shares that's going to be split? You have the 400,000, the original 400,000 and the 200,000 new shares. But now what I need to understand is the 200,000 new shares. Will you split them, or will you split the weighted average of the 200, 150? This is what I need to understand. 400,000 plus 150,000 times 3. I think this is what they did. Okay. But originally, handle this the split. Okay, this is where, okay, a 1-for-3 split means every one share becomes 3 shares. Yes, so all shares before the split must be restated as if the split happened on January 1st. Think of original 400,000 shares become 1,200,000. April is showing 200,000 shares become 600,000. The split is treated retroactively for EPS. So before considering treasury stock, okay. All right, so what I'm trying to understand here is the 200,000 shares, new shares for cash, April 1 as a stock option. Are we going to split these shares as is, or are we going to weight them before we split? Because if we use them as is, they will be 200,000 shares times 3. Or if we weigh them first, it will be 150,000 shares times 3. This part is very important. Weight first, then split. Okay? Alright, that makes sense. You weigh them and then you split. Weight them for the average months they have been outstanding and then split. Good. Does that make sense to me? I mean, it does make sense to me. I understand. If I get another question like this, I can deal with it. 1,575. 1,575. Okay. 1,575. All right. So let's go to the next one. Go to the next one. Prompt call is calculating earnings per share amount for inclusion in the annual report to shareholders. Prompt has obtained the following information from the Controller Office as well as shareholder services. Net income from January 1st to December 31st is $110,000. So we have net income. Corporate income tax rate is 30,000. So we may need tax rate. Number of outstanding common shares. Okay. January 1st to April 30th, 12,000 shares. May 1st to July 31st, 10,000. August 1st to December 31st, 12,000. In addition, Prompt has 1 million face value, 8%, 10-year convertible bonds outstanding on January 1st. The bonds are convertible into 5,000 shares of Prompt stock. Okay, this is very important. Assuming the bonds are anti-dilutive securities, what amount is Prompt's diluted earnings per share for the year ended December 31st? Okay. So what do we have? Assuming the bonds are anti-dilutive, what amount is Prompt's diluted earnings per share? So we need to calculate earnings per share. So we need the formula, which is net income. We have net income minus the dividend. We have the dividend, we can calculate it, minus the preferred dividend divided by weighted average of common shares. Weighted average of common shares, okay? So let's go. I have net income. Net income is $110,000. Corporate income tax is 30%. We may need that. Number of outstanding common shares. Okay, so outstanding common shares, January 1st to April 30th. So that's 4 months outstanding, 12,000. So we're gonna do 12,000. Let's do that. We will do 12,000. 12,000 times 4 months divided by 12. 12,000. Let's do it. 12,000 times 4 months outstanding divided by 12 months of the year. That's 4,000. So from January 1st to April 31st is 4,000 shares. May 1st to July 31st, that's 3 months. That's 3 months. We have 10,000 shares. So remember, we have 4,000. So 10,000 weighted for 3 months. Okay, sorry. We're going to have 10,000 times 3, 10,000 times 3 divided by 12. That's 250,000. Okay, 250,000. So that makes it 650,000. No, that's not what it is. We have 2,500. 2,500. So that's going to be 6,500. All right, 6,500. Right? Yes, 6,500. Cool. August 1st to December 31st. That's 5 months. Okay, 12,000 shares. So 6,500. Okay, 6,500. 12,000 shares. Times what? 5 months. Divided by 12. That's 5,000. Okay. So 5,000 plus 6,500. So that's 11,500. All right. So let me state that again. January 1st to April 31st, 12,000 shares. May 1st to July 31st, 10,000 shares. August 1st to December 31st, 12,000 shares. So what did we do? We weighed each one of them. January 1st to April 31st, that's 4 months. So we weighed 12,000. Outstanding for 12 months, it was 4,000. Then we did May 1st to July 31st, that's 3 months. Okay, that's 3 months outstanding. 10,000 shares. 10,000 shares become 2,500. So here we have 6,500. And then we have another transaction or activity from August 1st to December 31st. August 1st to December 31st is 5 months. 12,000 shares weighted for 5 months. It's 5,000. So that's why we have 11,500 shares outstanding. 11,500 shares. Okay. So what else do we have? We have, in addition, Prom has $1 million face value, 8% 10-year convertible bonds outstanding on January 1st. The bonds are convertible into 5,000 shares of prompt stock. Assuming the bonds are anti-dilutive. If they are anti-dilutive, we're not going to use them. We don't need to use them in the calculation. 8% of 1 million. This is the dividend. 8% of 1 million times 0.08. So $80,000. Okay. $80,000. As dividend, preferred dividend is $80,000. Net income is $110,000. So what we're gonna do? We're gonna do $110,000 minus $80,000 dividend is $30,000. $30,000 divided by what? By 11,500. That's $2.60. This is the EPS. Because they say it is anti-dilutive to $2.60, and that's not right. I need to see what's going on. The bonds are converted into 500 shares of prompt stock, but they are anti-dilutive. If they're anti-dilutive, do we use them in the calculation? Let me see. This is live. We are studying together. So let me see what we have. Let's see what we got. All right, just a moment. All right, so the key phrase in this question is assuming the bonds are anti-dilutive securities. That means ignore the convertible bonds completely when calculating diluted EPS. That's right. Ignore them completely. What about the dividend? Are we going to use the dividend from these bonds, or need to ignore that too? All right, that means ignore the convertible bonds completely when calculating diluted EPS. Step 1, calculate weighted average of common shares, which is what I did. January 1st to April 30th, 12,000. Okay. May 1st to July 31st, 10,000. August 1st to December 31st, 12,000. So the total is 11,500. Okay, so calculate basic EPS. Basic EPS is net income, which is 110,000 divided by weighted average shares of common stock, which is 11,500. All right, step 3, calculate diluted EPS. Normally for convertible bonds, we would add back after-tax interest to the numerator. Add the conversion shares to the denominator. However, the question says the bonds are anti-dilutive. Remember, dilutive, decrease EPS, include them. Anti-dilutive, increases EPS, exclude them. Therefore, diluted EPS equals basic EPS. Okay, that's okay. I see what happened. So I was not even supposed to use the dividend. Oh, because it's anti-dilutive, so ignore it completely. So the answer is net income divided by weighted average of common shares. We can do that. So it's going to be $110,000. $110,000 divided by what? By 11,500. So it's 956. 956 may be rounded to 957. Okay, makes sense. Makes sense. Remember that. This is very important. Okay. Very, very important. Very important. Remember this part right here. Diluted earnings per share, EPS, adjust the basic EPS formula by considering the conversion effects of all potentially dilutive securities. Only dilutive securities, that means securities that decrease EPS, are included in the calculation. The weighted average number of common shares outstanding must be adjusted for stock changes during the year. Shares issued or required must be weighted for the portion of the year they are outstanding. Okay. Remember this part. Clip it. Diluted earnings per share. Adjust the basic EPS formula by considering the conversion effects of all potentially dilutive securities. Only dilutive securities, that means securities that decrease EPS, are included in the calculation. The weighted average number of common shares outstanding must be adjusted for stock changes during the year. Shares issued or reacquired must be weighted for the portion of the year they are outstanding. Share issued or reacquired? That's not totally true. Share issued need to be weighted for the portion of year they were outstanding, but shares we reacquired, when you purchase your own shares, they need to be weighted for the portion of the year they were not outstanding. Remember this part. Okay. This is very important. Muy importante. Muy importante esto. This is very important. Let's go to the next one. When determining earnings per share, interest expense, net of applicable income taxes on convertible debt that is dilutive should be, when determining earnings per share, interest expense, when determining earnings per share, EPS, interest expense, okay, interest expense, net of applicable income taxes, okay, on convertible debt that is dilutive should be, the interest needs to be added back to weighted average common shares outstanding. No. Earnings per share, interest expense, net applicable income taxes, they need to be added back to net income. Added back to net income, yes, for diluted earnings per share. Deduct, added back to, yes, added back to net income. That's correct. Okay. added back to net income. The calculation of diluted earnings per share, EPS, considers the conversion effect of all potentially diluted securities. It can be converted into common stock. The if converted method is used, in which it is assumed that any convertible security, example, convertible debt, stock options, convertible preferred stock, that could convert to common stock will. If the conversion has dilutive effect, that means decreases EPS, it is included in the calculation. If anti-dilutive, that means increases EPS, it is excluded in the from the calculation. Okay? Understand this. When applying the if converted method to convertible bonds, the company theoretically avoids interest expense on the debt security, example, bonds payable, since it is assuming the security has converted to stock. All right, so it's time for break. We're going to take a break and we'll come right back to this part.
Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom. Critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. With a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you've got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. Ooh, with a great memory. With a great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp. Ooh, with a great memory. With a great memory. May you pass every exams. Come study with me. Come and study with me. Come and study with me. Come work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. Oh, one page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. With a great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp, with a great memory. With a great memory. May you pass every exams. Come study with me. Come study with me. Come and study with me. Come study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. Oh, one page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me.
All right, we are back.
What it takes.
Let's go ahead and keep going.
You've got what it takes.
Okay. We were... All right, so let's go back to where we left off. Okay, so the calculation of diluted earnings per share considers the conversion effect for all potentially dilutive securities. That means can be converted into common stock. The if converted method is used, in which it is assumed that any convertible security, example convertible debt, stock options, convertible preferred stock, I believe warrants, that could convert to common stock will. If the conversion has dilutive effect, that means decreases EPS, it is included in the calculation. If anti-dilutive, that means increases EPS, it is excluded from the calculation. When applying the if converted method to convertible bonds, the company theoretically avoids interest expense. Interest expense on the debt security. Example, bonds payable. Since it is assuming the security has converted to stock, the conversion is treated as if it occurred at the beginning of the earliest period reported or at the time of issuance if later. The interest expense net of tax is added back to the net income. Clip this. The interest expense net of tax is added back to net income in the numerator of the EPS formula. Very important. The number of common shares, not the after-tax interest expense, that would be issued if the security converted are added to the weighted average common shares outstanding in the denominator. All right, so what do you need to remember? When calculating diluted earnings per share, EPS, potentially dilutive convertible securities are accounted for using the if converted method. When applying the if converted method to convertible debt securities, the debt interest expense net of tax is added back to net income in the numerator of the EPS formula. We remember that. Okay. Next question. So let me read the question again. When determining earnings per share, interest expense, net of applicable income taxes on the convertible debt, that is, dilutive should be added back to net income for diluted earnings per share. Added back to net income. Okay, added back to net income. Which of the following is the annual report? Which of the following is the annual report that is filed with the United States Securities and Exchange Commission? Annual one, the 10K. Right? Remember, annual is 10K. Form 8K is for a major event, material event. So when something happens, right? 8K, 10K is annual report. S1 is for IPO, initial offering. 10Q is quarterly report. Okay, remember this, clip it. A company reported net income available to common stockholders of $2 million for the year ended December 31st, year 2. The company has had 1,500,000 shares of common stock outstanding as of January 1st, year 2, and issued 500,000 additional shares of common stock on May 1st, year 2. What amount is the company's basic earnings per share for year ended December 31st, year 2? So here we are only calculating basic earnings per share, right? Basic earnings per share is just the net income minus preferred stock dividend divided by weighted average of common shares. What do we have? Company reported net income. So we have net income of $2 million for the year ended December 31st, year 2. Okay, so we have net income. The company had 1,500,000 shares of common stock. So that's the original common stock. We have the initial one, 1.5 million outstanding, and issued 500,000 more, or 500,000 additional shares of common stock on May 1st. On May 1st, year 2. So what we got to do is just to average the 500,000 additional shares. May is the 5th month of the year, but we also need to count May in the calculation because it's May 1st. Okay. So that's going to be 8 months. This is going to be 8 months. All right, so 500,000 times 8 months outstanding divided by 12 months of the year. So 333,333 infinite, unlimited. So 333,333. What? So outstanding. So I'm gonna say this plus what? Plus the 1.5 million. 1,500,000. Okay, so that will be 1,800,033, 333. This is what? This is weighted average of common stock. Okay. So what was net income was 2 million. 1,833,333.3333. Okay. 1,833, and then everything is 3. All right. So what we're going to do is 2 million divided by 1,833,333.33. So that's 1.09. Yes. Here we have 1.00, 1.09. That's correct. Okay, so in this case, we didn't need to get any help. We were able to understand this question. A company has basic earnings per share of $12.18. If the tax rate is 25%, which of the following securities would be dilutive? 15,000 15,000 incentive stock options with an exercise price of $17 to its employees and an average market price of $15 per share. Cumulative 9%, $30 par preferred stock. Okay, we have a lot of information here, but let's go step by step. A company has basic earnings per share of $12.18. If the tax rate is 25%, which if the tax rate is 25%, which of the following securities would be dilutive? If the tax rate is 25%, which of these will decrease EPS? When we say dilutive, that means it decreases EPS. Which one? The first option is 15,000 incentive stock options with an exercise price of $17 to its employees and an average market price of $15 per share. Now, this would answer the question right there, because here's what we need to understand. If the exercise price, remember that, let me find that again. If exercise price is greater than market price, I may understand that. Exercise price is greater than market price, then it is anti-dilutive. It's out of I mean, you will not even use it, right? Because what is the exercise price? Exercise price is $17. Market price is $15. So this one is anti-dilutive. Cumulative 9%, $30 par preferred stock. What does that mean? Cumulative 9%, $30 par preferred stock. I need to understand that, but I would say this is the one that would, which of the following would be dilutive? The cumulative 9% $30 par preferred stock. But let's get some explanation. But the first one already told me that it's anti-dilutive because exercise price is greater than market price. No one would buy it. If I have the option to exercise at $17, but when I check the market price is $15, I will not exercise. So that means it's invalid. I will not exercise. It's invalid. Therefore, it's anti-dilutive. So let me see. Let's walk through this the far way. The question asks which securities would be dilutive. You have two securities: incentive stock options, cumulative preferred stock. Okay. Step 1, analyze stock options. The option exercise price is $17. The average market price is $15. Ask yourself, why would an employee exercise an option to buy a stock for $17 when they could buy it in the market for $15? Right? It doesn't make sense. They would not. These options are out of the money. CPA rule: exercise price less than market price, dilutive. Exercise price greater than market price, anti-dilutive. Since 17 is greater than 15, the options are anti-dilutive. Result: incentive stock options not dilutive. So the next option, even if you don't understand the next option, since this is the only one that's available, it will be the correct answer. Okay? Analyze the cumulative preferred stock. This is the one I didn't understand. Here is part many CPA candidates miss. The question does not say convertible preferred stock. It only says cumulative 9% $30 par preferred stock. That's just regular preferred stock. Regular preferred stock already affects basic EPS through preferred dividends. That's true. Does not create additional common shares. Therefore, there is no dilution. Oh, wow. Result, cumulative preferred stock, not dilutive. Wow. Okay, I would still lose it. It's not dilutive. I need to understand this part. So both are not dilutive. Cumulative 9% $30 par preferred stock. I need something clearer than that. Neither security is dilutive. If the answer choices continue below, okay, all right, it's no, cool. All right, so I need some more explanation of this cumulative 9. Okay, explain to me the second option. All right, so the cumulative 9% $30 par preferred stock. Give me all the details that I need to know to master this, to understand it. Yes. Okay. So let's master it from the ground up. What does 9% $30 par cumulative preferred stock mean? Break it apart. Preferred shareholders get paid before common shareholders. Think of them as VIP shareholders. Yeah. If the company earns money, preferred shareholders get their dividend first. Whatever is left belongs to common shareholders. $30 par. Par value is the face value assigned to each preferred share. $30 per share. 3.9%, this is the dividend rate. Where did we get 3.9%? I didn't see it at 3.9%. 3.9%, this is the dividend rate. 3.9% came from. Okay. This is the dividend rate. 9% times $30 is $2.70. Each preferred share receives $2.70 dividend annually. Example, suppose the company has 10,000 preferred shares. Dividend per share is $30 times 9% is $2.70. Total preferred dividends, 10,000 times $2.70, $27,000. Why do we care in EPS? Remember, EPS belongs to common shareholders. Preferred dividends are not available to common shareholders. Okay. Therefore, basic EPS equals net income minus preferred dividend divided by weighted average of common shares. Example, net income is 100,000, preferred dividend is 27,000, common shares is 10,000. Okay, so that's 730, 7.3. Notice the preferred dividend reduced EPS. What does cumulative mean? This is very testable. Cumulative means if the company skips the dividend this year, it still owes it. The dividend accumulates. Example, year 1, preferred dividend owed $27,000. Company pays nothing. Balance due $27,000. Year 2, another $27,000 is owed. Now total owed is 54,000. Okay? Total owed is 54,000. The company must pay preferred shareholders before common shareholders receive anything. EPS rule for cumulative preferred stock. This rule appears constantly on FAR. For cumulative preferred stock, deduct the annual dividend whether declared or not, even if no dividend is declared. Why? Because preferred shareholders earned it. Example, not net income. Whew, that's too much. That's too much explanation. It's getting me lost. Alright, I need a shorter explanation. I'm just getting lost in the sauce. That's too much. So, a shorter explanation to make it make sense. I'm just trying to understand why 9% $30 par preferred stock it's anti-dilutive. It is not actually anti-dilutive. It is simply not a dilutive security at all. Ask yourself one question. Can this preferred stock turn into common shares? The question says cumulative. 9%, $30 par preferred stock. It does not say convertible preferred stock. Okay. So no conversion feature, no new common shares created, no increase in EPS denominator. Therefore, it cannot dilute EPS. Think of it this way. Okay, let's stop right here. That's it. All right. So, what I need to pay attention to in this question is the language. If it says convertible, it is dilutive. If it does not say convertible, it says cumulative. It is not dilutive. Therefore, that's it. There is nothing else I need to look for. Here is the FAR exam shortcut. For preferred stock, ask, does it say convertible? Convertible preferred stock, potentially dilutive. Test it. Non-convertible preferred stock, cumulative or non-cumulative, a dilutive security. Non-convertible preferred stock. So in your question, cumulative 9% $30 par preferred stock. The important word is actually what is missing. No convertible. Therefore, not dilutive. Okay? One small correction. Don't say if it says convertible, it is dilutive. Instead say if it says convertible, it is a potential dilutive security and must be tested. Okay? Makes sense. Why sometimes a convertible security can be anti-dilutive and must be excluded. For example, convertible preferred stock, test. Convertible bonds, test. If they reduce EPS, include. If they increase EPS, exclude them. Okay. That makes sense. All right. For the sake of this question, the only word that makes the difference is convertible. If it does not say convertible, it is already anti-dilutive. Yes. For this question, that's exactly how I would think about it. When you see cumulative 9%, $30 par preferred stock, your brain should immediately ask, do I see the word convertible? No, not a dilutive EPS security. Therefore, answer is no. Okay, it makes sense. That's all I needed to know. You see? It's all I needed to know. So it's just one word. Alright, so let me ask the question again. A company has basic earnings per share of $12.18 if the tax rate is 25%. Which of the following securities would be dilutive? You see? Here you can do the math. But if you understand the language, I believe it's more language than math. Because the first option is 15,000 incentive stock option with an exercise price of $17 to its employees and an average market price of $15 per share. When the exercise price is greater than the market price, it is anti-dilutive. You don't need to calculate anything. You don't need to do any math. When you see the exercise price is greater than the market price, it is anti-dilutive. So this one, you already know it's a no. The second one, cumulative 9%, $30 par preferred stock. When you look at this one, if you don't see the word convertible, preferred stock, convertible, it's anti-dilutive. So now you already know in 2 seconds, in 5 seconds, you already answered the question in 5 seconds. Because you say, okay, exercise price is greater than the market price. This is invalid. It is anti-dilutive. Cumulative 9%, $30 par preferred stock. I see preferred stock, but I don't see convertible. It is anti-dilutive, so it's a no. This is where you see, okay, it's no. Make sense? Good. I love this. Okay. All right. I love this. Dun, dun, dun. I love this. This is beautiful. Okay. Dun, 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 dun. Okay. Based on the stock transactions below, what is the weighted average number of shares outstanding as of December 31st, year 1? That should be used in the calculation of basic earnings per share in the financial statement issued in March 1st, year 2. Oh, wow. Okay. Don't worry about March 1, year 2. Earnings per share in the financial statement issued. All right, but December 31st, year 1, that's what it says. That's what you got to pay attention to. So we have the dates, we have the transactions. From January 1st, year 1, we have beginning balance of 100,000 shares. This is outstanding for the whole year. April 1st, year 1, we have 30,000 shares for cash. So outstanding from April 1st through the rest of the year. June 1st, year 1, 50,000 stock dividend. 50%. Oh, 50% stock dividend. 50% of what? 50% off whatever you had previously. Okay, we're gonna see. February 15, year 2, 2-for-1 stock split. All right, so we're gonna have a split of all of these that we had previously. March 15th, year 2, issued 40,000 shares for each. Issued 40,000 shares for cash. Okay, so for each. For cash, 40,000 shares for cash. That shouldn't be that hard, okay? Beginning balance is 100,000 shares. This is outstanding throughout the whole year. April 1st, year 1. April is the 4th month of the year. Okay? But it's April 1st. It's going to be 9 months outstanding. The transaction is 30,000 shares. Let's wait that for 9 months. 30,000 shares. Okay? So 30,000 times 9 divided by 12. So 22,500. We will do 22,000, 100,000 plus 22,500. So that's going to be 122,500 shares. Okay. 122,500. April 1st. Okay, that's what we just did. Then there is a 50% stock dividend. Let's do that. Plus 100,000. That's 122,500. And then we have a 50% stock dividend. I believe it's a 50% of this number here, of the 122,500. So I'm gonna do 50% of this divided by 2. That's 61,250. 61,000, and it's a stock dividend. You will make as if they have been outstanding the whole year. So you don't need to weigh them for the month they have been outstanding. You'll make as if they have been outstanding for the whole year. So 61,250. I'm gonna do 122,500 plus 61,000. 122,500. 122,500. Okay. Plus 122,500. So that's 183. 183,750. All right, 183,750 on that was in June. All right, don't worry about what happened in June because it happened for the whole year. February 15th, year 2. Year 2. Oh, I was in year 1, now I'm in year 2. The question asks, wait. What's the question? That should be used December 31st, year 1. Wait, based on the stock transaction below, what is the weighted average number of shares outstanding as of December 31st, year 1? So we don't need anything about year 2. Why are they including anything about year 2? We don't need to know anything about year 2. Okay. So stock outstanding for year 1 are the transactions happen in year 1. So, but I have transactions happen in year 2. February 15th, year 2. March 15th, year 2. I don't need to know about these transactions because I only need to know about transactions that happened before December 31st, year 1. December 31st, year 1. Okay? December 31st, year 1. They trying to confuse you. It would be 183,750. Yes, it's right here. And it's not correct. They tricked me. They tricked me anyway. 367. 367. What? 367. Let me add something. February, March 1st. Okay, so let me add the February transaction. February year 2. It shouldn't be in part of it. All right, so we have a split, a 2-for-1 split. So we have 183 times 2. $367. Wow. So, all right. Let's see where the trick is coming from. Yeah, I see where the trick is coming from. There are transactions. All right, here's what the question says. The question says, based on the stock transactions below, what is the weighted average number of shares outstanding as of December 31st, year 1? As of December 31st, year 1. That should be included. That should be used in the calculation of basic earnings per share in financial statements issued on March 1st, year 2. I believe if we are calculating as a average number of shares outstanding as of December 31st, year 1, we don't need to include anything that's going on in year 2. But here there is something that happened in February 15th of year 2 has been included, which is the 2-for-1 split. That still doesn't make sense to me. Still doesn't make sense. Let me see. Let me get some explanation. Oof. Okay. Need to sit straight. Let me see what they say here. Must be added. The weighted average shares outstanding must be adjusted for stock changes during the year. Stock splits and stock dividends, including those that occurred after the balance sheet date, but before the financial statements are issued, are treated as though they had occurred at the beginning of earliest period presented. Oh wow. I did not know that. I did not know that. Here is the rule. Here is the rule. The WASO weighted average weighted average. Just don't remember. I just don't remember. The WASO must be adjusted. Weighted average stock outstanding. I was gonna say stock options. That's what was coming to my mind. Weighted average stock outstanding must be adjusted for stock changes during the year. Stock splits and stock dividends, including those that occurred after the balance sheet date, but before the financial statements are issued, are treated as though they had occurred at the beginning of the earliest period presented. Okay, that's the trick. So the financial statements were issued on March 1st, but there is a transaction that happened on February 15th. Even though the question asks us for average number of shares outstanding as of December 31st, year 1, if a transaction happened in year 2 before the financial statements were issued, it needs to be included in the calculation. Remember that. Okay, needs to be included in the calculation. All right. Needs to be included in the calculation. Okay. Still have 30 minutes. All right. So here, the other question. What calls dividends on non-cumulative preferred stock have been declared but not paid? Have been declared but not paid. What has not declared or paid dividends on its cumulative preferred stock in the current year or the prior year, and has reported a net loss on the current year? For the purpose of computing basic earnings per share, how should the income available to common stockholders be calculated? What calls dividends on non-cumulative preferred stock have been declared but not paid? What calls dividends on non-cumulative preferred stock have been declared but not paid? What has not declared or paid dividends on the cumulative preferred stock in the current or the prior year, and has reported a net loss in the current year? For the purpose of computing basic earnings per share, how should the income available to common shareholders be calculated? Well, there is no income available to common shareholders until you pay preferred shareholders, and you haven't paid them. You have not paid them. So the current year dividends and the dividends in arrears on the cumulative preferred stock should be added to the net loss, but the dividends on the non-cumulative preferred stock should not be included in the calculation. The dividends on the non-cumulative preferred stock should be added to the net loss, but the current year dividends and the dividends in arrears on the cumulative preferred stock should not be included in the calculation. The dividends on the non-cumulative preferred stock and the current year dividends on the cumulative preferred stock should be added to the net loss. I want to understand what you're talking about. Neither dividend on the cumulative preferred stock nor the current year dividends and the dividends in the arrears on cumulative preferred stock should be included in the calculation. Calculation of what? For purpose of computing basic earnings per share, how should the income available to common stockholders be calculated? Okay, I understand. The current year's dividend and the dividends in arrears on the cumulative preferred stock should be added to the loss, but the dividends on the non-cumulative preferred stock should not be included in the calculation. That's correct. But the dividends on the non-cumulative preferred stock should not be included in the calculation. The dividends on the non-cumulative preferred stock should be added. All right, let me get some explanation on this. Okay. Let's get some explanation. Okay. Let's see. This is more language than math to understand the tricks. This question is testing one of the most important EPS rules. Let's simplify it. The facts: non-cumulative preferred stock, non-cumulative preferred dividends were declared. Cumulative preferred dividends were not declared. There is a net loss. The question asks how much of the loss belongs to common shareholders. Rule number 1, non-cumulative preferred stock. You only count the dividend if it is declared. In this question, declared, therefore included. Rule number 2, cumulative preferred stock for EPS. You always count for EPS, sorry. Rule number 2, cumulative preferred stock. For EPS, you always count the current year's dividend, whether declared or not. Okay? For EPS, you always count the current year's dividend, whether declared or not. But do not count dividends in arrears, prior year missed dividends. The shortcut for EPS preferred stock type, non-cumulative, only declared dividend. Cumulative, current year dividend only. Only. Dividends in arrears never included. Therefore, include non-cumulative preferred dividend because they were declared. Current year cumulative preferred dividends do not include dividends in arrears. That matches choice C. Okay. CPA memory trick. When you see dividends in arrears, immediately think not for EPS. When you see cumulative preferred stock, think current year only. When you see non-cumulative preferred stock, think only if declared. We gotta clip that. Gotta clip that. CPA trick. Let me say this here. CPA trick. When you see dividend in arrears, immediately think not for EPS. So this is not included in the EPS calculation. When you see cumulative preferred stock, think current year only. You only use current year dividend in the calculation of EPS. When you see non-cumulative preferred stock, you think only if declared. If declared, you can use it in the calculation. So let's see the answer. The dividends on the non-cumulative preferred stock and the current year dividends on the cumulative preferred stock should be added to the net loss. Okay. The dividend on the cumulative preferred stock because it was declared. The dividend on the non-cumulative preferred stock because it was declared. And the current year dividends on the cumulative preferred stock should be added to the loss. Okay. Should be added to the loss. Okay. When computing earnings per share, net income must be adjusted for preferred stock dividends. Only declared dividends for non-cumulative preferred stock and the current annual dividend, regardless if declared or paid for cumulative preferred stock, is deducted or added to net income or loss. Okay. Okay. On June 30th, year 8, Lomond Inc. issued 10,000 7% bonds at par. Each bond was convertible into 200 shares of common stock. On January 1st, year 9, 10,000 shares of common stock were outstanding. The bondholders converted all the bonds on July 1st, year 9. The following amounts were reported in Lomond's income statement for the year ended December 31st, year 9. Okay. Revenue, $977,000. Operating expenses, $20,000. Interest on bonds, $7,000. Income before income tax, $50,000. Income tax 30%, $15,000. Net income, $35,000. What is Lomond's year 9 diluted earnings per share? You can calculate diluted earnings per share, but I feel that I want to take a break. Let me see how long we have. 19 minutes left for break. Yeah. 18 minutes left to take a break. Feel that I've been talking too much. All right, who's studying with me today? This is only for CPAs, CPA students. Okay, so in this case, let me get this explained. We have a few more questions to go. We should have some courage to continue. Yes, so let me see. Hey, he's not responding. Okay. It's blurry. All right, so $20,000 or 7% bonds. All right. $20,000, 7% bonds. Interest expense $2,000. Income before tax $50,000. Tax rate $30,000. And before tax, yeah. but I can. All right, let's do this. Let's do this now. All right, so this is a beautiful EPS question because it teaches a huge concept. When calculating basic EPS, use what actually happened. When calculating diluted EPS, pretend the conversion happened on January 1st. Let's walk through it. Step 1, what happened? There were $10,000 or 10,000 common shares outstanding all year. 20 bonds. Each bond converts into 200 shares. So conversion creates 4,000 shares. The bondholders converted on July 1st, year 9. Step 2, basic EPS denominator. For basic EPS, we use actual shares outstanding. Actual shares outstanding from January 1st to June 30th. That's 6 months. 10,000 times 6 divided by 12 is 5,000. Okay. From July 1st to December 31st, we had 14,000. July 1st to December 31st, we had 14,000 shares. So 14,000 times 6 divided by 12, that's 7,000. Weighted average shares, 5,000 plus 7,000, that's 12,000. So basic EPS calculation is the net income is 35,000. Yes, net income 35,000 divided by 12,000 is 2.92. Step 3, diluted EPS. Now we pretend. What if the bonds had been converted on January 1st? That's the if converted method. If converted method. Numerator, net income, 35,000. Add back after tax interest expense, 7,000. You have the interest expense, which is 7,000. Tax rate is 30,000, so you're gonna do the interest times 1 minus t, which will give you $4,900. That's the interest. So the interest will be added back to net income. Okay, added back to net income. So 35,000 plus 4,900, that's 39,900. Denominator, pretend conversion occurred January 1st. Original shares, 10,000. 10,000 shares. Additional conversion shares, 4,000. Total 14,000 shares. Diluted EPS, 39,900 divided by 14,000. That's 2.85. The FAR lesson for convertible bonds. Numerator, add back after tax interest. Denominator, add conversion shares as if conversion happened on January 1st. That is the entire if converted method in one sentence. A question for you. Why do you think we add back only 4,900 instead of 7,000 in interest expense? That's the key concept that makes diluted EPS really click. It's because we remove taxes, right? We remove tax. The reason we remove tax is because if you're not paying interest, you cannot take advantage of tax, right? So that's why we remove tax. If you were paying the interest on bonds, on these bonds, so the interest on the bond will be $7,000 every year. Because you're paying $7,000 every year for interest, you will have a tax deduction. The tax deduction, so you're going to have a tax deduction, a tax benefit because you're paying that interest. And your tax benefit is what? Is 30%. It's 30%. But now, since you're not using tax, so since you're not paying the interest, you cannot take advantage of the tax. So that's why we say we cannot add back the $7,000. We need to remove taxes, and then we add back the $4,900. Add back $4,900. Okay. So the answer is what? 285. What did we do? Revenue, operating expense. We don't need all of that information. We need interest on bonds. We need that. Income before income tax. Income tax at 30%. It's a lot of information. We need net income. So once you know the formula is, what is the question? What is year 9 diluted earnings per share? We are calculating EPS. So if we are calculating EPS, there are a lot of information we don't need. What we need is net income, which we have is 35,000. We need net income 35,000 minus preferred dividend. Do we have any preferred dividend? Income before interest and bond operating. Okay. No, so we don't have preferred dividend. But we will need to add back the interest. So we will add back interest on 35,000, which is 4,900 after tax interest. Okay, after tax interest, we add that on 35,000. It becomes 39,900. So this is our numerator. For denominator, we need the weighted average of shares. Where do we get the shares? We have net income, income tax, income, interest on bonds, operating expense, revenue. We don't need that. So let me see. We have issued $10,000, 7% bonds at par. Each bond was convertible into 200 shares of common stock. On January 1st, year 9, 10,000 shares of common stock were outstanding. We had 10,000 shares of common stock outstanding. The bondholders converted all the bonds on July 1st, year 9. So they had bonds, all the bonds were converted. I need to understand this language here. Okay. Help me interpret phrase by phrase the question. Help me interpret the question so that I understand what they are talking about. All right. We are almost there. We almost done. Okay. We are almost done. Perfect. This is exactly how you should approach FAR questions. Let's go sentence by sentence. Sentence 1. On June 30th, year 8, Lumen Inc. issued $10,000, 7% bond at par. Translation: the company borrowed money, 20 bonds. Each bond equals $10,000. Total debt 20 times 10 is $200,000. The company now owes bondholders $200,000. The 7% means the company must pay interest. Mental note: I have bonds outstanding. This may affect diluted EPS. Sentence 2: each bond was converted into 200 shares of common stock. This is the most important sentence. The word convertible should immediately set off an alarm in your mind or in your head. CPA translation: this is a diluted EPS question. Calculate possible new shares. 20,000 times 200 is 4,000 shares. Mental note: if converted, 4,000 additional common shares appear. Sentence 3. On January 1st, year 9, 10,000 shares of common stock were outstanding. Translation: the company starts year 9 with 10,000 common shares. Mental note: this is my starting denominator. Sentence 4. The bondholders converted all the bonds on July 1st, year 9. This is huge. Translation: for the first 6 months, 10,000 common shares. For the last 6 months, 10,000 plus 4,000 equals 14,000 common shares. Mental note: this matters for basic EPS because basic EPS uses what actually happened. Sentence 5. The following amounts were reported in Lumen's income statement for the year ended December 31st, year 9. Translation: everything below belongs to year 9. This income statement is giving us the information needed to calculate EPS. Okay. The story is really 1. The company has 10,000 shares. Company has convertible bonds. Bonds can create 4,000 shares. Conversion happened on July 1st. Interest expense exists because bonds were outstanding. Compute EPS. All right. We will understand that. Not too hard to understand. All right, so we have 2 minutes left. We're gonna take a break. After the break, we may continue or we may not continue after this break. I believe we're not going to continue on live after the break. But if you've been with us, thank you very much for sticking around. If you're studying for CPA, I wish you the best. This is far is one of the most intense ones, most intense one according to what people say. So that's why I'm doing it first. So let's go ahead and motivate each other. Let's continue to study so that we can pass this exam. All right. Thank you very much and stay productive.